Guests and colleagues, welcome to today's seminar on China's economic outlook, risk, and policy challenges. Today's presentation will provide crucial insight into the current state of Chinese economy. You could have been better person than Ms. Sonali Jain-Chandra, who led the recently published 2024 IMF Article IV consultation on China. She serves as Assistant Director and Division Chief at the IMF's Asia Pacific Department. Her extensive experience includes work across major Asian economies, including India, Korea, Indonesia, and Hong Kong. Her contribution to the IMF Regional Economic Outlook and her previous work on emerging market vulnerabilities make her uniquely qualified to address today's topic. Today's session will be moderated by Dr. Janak Raj, Senior Fellow at CSEP, where he leads the macroeconomic segment in growth finance and development. Dr. Raj brings over 4 decades of invaluable experience from his role at Reserve Bank of India, IMF, and the Ministry of Finance. His distinguished career includes serving as Executive Director at RBI and as a member of a Monetary Policy Committee. Now, may I request Dr. Raj to conduct the seminar?
Yeah, thank you, Subhanshi. So, Sonali, thank you very much. Welcome to this CSEP. It's your first visit to CSEP, isn't it?
It is,
Yeah,
yes.
welcome. So, you will have about 25 minutes to 30 minutes for your presentation, and then we'll have a conversation between us for about 20 minutes. Then we'll open the floor for discussion. So, may now request you to please make the presentation. Yeah.
This just takes us back and forth, right? The
Yeah.
slides?
Yeah, just try.
Okay.
Can you otherwise guide her?
Okay, perfect. Okay, great. Thank you. Good afternoon, everyone. It's a real pleasure to be here at CSEP, and Janak is absolutely right. This is my first visit here. I'm here to present the IMF's view on China's economic outlook, risks, and policy challenges. This basically is work that my team has done over the last 2 years or so for the Article IV consultations in China. So let me give you, before we get started, a bit of a roadmap in terms of the presentation. It will be divided into 4 sections. I think it's a bit of a challenge to finish in 25 minutes, but I will do my best. So the first, in terms of a roadmap, the first section will be on China's outlook and risks amid weak domestic demand and a very difficult external environment. Then I will move to our recommendations for upgrading China's policy frameworks. Third, I will discuss our policy recommendations to reignite sustainable growth in China. And finally, given China's size, I want to spend some time talking about trade fragmentation and China's spillovers globally. So with that, let's get started. Turning first to China's own domestic economy, in turn, rather before going to the impact on the globe, I want to go sort of component by component when we look at China's outlook and demand. Turning first to consumption, I think it's a well-known stylized fact that China's consumption has been structurally low over many decades for a long period of time, but it was especially depressed during the pandemic. After the reopening from China's fairly substantial COVID lockdowns in early 2023, we see that consumption did bounce back. In terms of contributions to growth, which is shown on the left-hand side chart, we see that consumption played a major role. Consumption is the blue bar. It played a major role in the bounce back in 2023, but this bounce back proved to be short-lived. After sort of the base effects and the bounce back from COVID lockdowns, we see that over the course of 2024, indeed, consumption has declined quite significantly. And with steady industrial production, growth in 2024 is increasingly driven by investment as well as net exports, and this has an impact for the global economy. Underpinning weak consumption in China is really weak consumer confidence, as you can see in the right-hand side chart. The blue line is consumer confidence in China. This is at historically low levels. It fell dramatically during the Shanghai lockdowns in the second quarter of 2022 and hasn't really recovered in a meaningful way. And mirroring this, you see the red dotted line, which is responses of residents who want to increase their savings. And this, of course, has an implication for their desire to consume. Turning next to the property market, I think this is an area in which there has been a lot of discussion as China is undergoing essentially a property sector crisis, which has now entered its fourth year. The left-hand side chart shows that the real estate sector in China continues to contract. And this is true no matter which indicator you look at. You look at starts, which is the leading indicator of property activity. You look at sales. You look at real estate, fixed asset investment, which is what really matters for the national accounts. Across the board, with some up and down, you see that the adjustment continues into 2024. We, in our projections, assume that this is going to stabilize in 2025, but it remains to be seen. I think the recovery in real estate investment is likely to be slow in the medium term. This is based on other countries' experiences that are recovering from a real estate crisis. This is illustrated in the second chart, which shows that real estate GFCF, the gross fixed capital formation, after the crisis is likely to be subdued well into a decade after the crisis began. This is based on a sample of other countries, and China is the red line, and those are our projections. Moving forward and now turning to investment, authorities have tried to offset the weakness in real estate investment by ramping up manufacturing as well as public investment. And to some extent, they have been successful in this attempt. If you look at the left-hand side chart, you see that the blue line, which is private fixed asset investment, is broadly flat, where real estate FAI, which is declining, has been offset by manufacturing fixed asset investment. Manufacturing investment has been ramped up to the so-called priority sectors deemed a priority by the government, and also public investment has held up, at least in the first half of this year. Having said that, there are initial signs that this approach may be hitting its limits. In the right-hand side chart, you see some of the higher frequency indicators on investment, and infrastructure investment has started coming down quite sharply in recent months. I think this is consistent with a decline in the net financing of the local government financing vehicle bonds that have been used to finance infrastructure in China. Another manifestation of very weak domestic demand in China is core inflation. I think it's well known as the world grappled with inflation post-COVID reopening. China's experience has been quite different. Despite reopening, despite the initial bounce back in activity, core inflation has trended to come down quite significantly. You see that in the left-hand side chart. The latest print for core inflation is very close to zero. It's 0.1% in September, and we're actually seeing sequential core inflation already in negative territory. And combining this with the GDP deflator as well as PPI, the PPI being in deflationary territory for the last 2 years, I think this is a cause for concern. On the labor market, also there is weakness reflected across different sectors, whether you look at services, construction, or manufacturing. And this is the chart on the right-hand side. Turning next to the external environment, as I had mentioned at the beginning of the presentation, China is facing a very difficult external environment. Let's look first on the trade side. China is facing a number of trade restrictions directed towards it by other major economies. Notwithstanding this, so far, China's net exports have remained resilient. They've remained above pre-pandemic levels. This is the chart on the left-hand side. I think it's a combination of both exports overperforming amid falling export prices in China, which has rendered their exports more competitive, as well as weak domestic demand, which has depressed its imports. So net exports have, as you can see, have remained relatively strong. It's an open question what happens going forward. Turning to capital flows, as you can see from the right-hand side chart, the red dotted line is net portfolio flows, which were deeply negative after reopening, driven by bonds and equities to some extent. These have now just started reverting back to, close to zero. More worrying sign is that inward FDI in China has been on a downward trend. These are the blue bars above the x-axis. And this has fallen quite sharply during the pandemic. And it's now, at the same time, you have outward FDI, which are the light blue bars just below the x-axis. That's broadly stable. But on a net basis, net FDI has been negative in certain quarters in China, which is another relatively new phenomena. Turning now to our outlook on China, our growth forecast during the Article 4 that was released in August, as well as the World Economic Outlook in July, was at 5%, which is consistent with the authorities' growth target. However, as I just illustrated, the incoming data for China has been quite weak. In particularly private consumption and now increasingly investment. So notwithstanding the stimulus measures that were unveiled by the authorities in September, we've just downgraded our growth forecast for China to 4.8% in the October World Economic Outlook that was released just last week. I would note that the October fiscal measures that the authorities have unveiled is not yet in our forecast because that came after the World Economic Outlook was frozen. Our forecast for 2025 remains at 4.5%, which is anchored by the assumed stabilization in the property market that I had mentioned earlier. And over the medium term, I think we have quite a sober outlook for China, with growth falling to below 3.5% over the medium term. This is a point I'm going to come back to in some detail towards the end of the presentation. So now turning to risks around this forecast, I think the outlook is subject to a number of downside risks, but the balance of risks at this point in time is a little bit more favorable because there may be stimulus forthcoming, at least in terms of near-term growth. The key downside risk is one of deflation getting entrenched. This was featured very prominently. We've done a lot of work on sort of leading indicators for deflation and the like. This could lead to negative feedback loops given, sort of weak domestic demand, high indebtedness, etc. So this is one key risk to watch out for. Another one is deepening geoeconomic fragmentation, which would hurt China disproportionately. And also present are the risks of a longer than or larger than expected decline in real estate investment unless appropriate policy action is taken. Finally, there could be unintended fiscal tightening if local governments face financing constraints. I should also note that there are upside risks. There's growing expectation of additional fiscal policy support that could support at least near-term growth. And also, if there's a comprehensive policy package to end the property sector crisis, that could support the outlook. Turning now to the IMF's short-term policy advice for China, I think from our perspective, the immediate priority is to facilitate a less costly and more efficient adjustment in the property sector. To be clear, the property sector is undergoing a much needed adjustment. We don't think the adjustment needs to stop, but it can be made a little less costly. And I think the duration can also be shortened. And I think what we are advocating for is three things. The government has done a number of has undertaken a number of measures to put a floor under the property sector, but there are a couple of things that are missing from this policy package. One is to use central government financing to accelerate the completion of unfinished pre-sold housing that households have already paid for, but this has not been delivered by essentially zombie developers. The second would be to ensure a timely resolution of an exit of the unviable developers. Finally, it is to allow for greater house price flexibility in order to support housing demand and help clear the overhang of inventory in the housing market. Turning to fiscal policy, we think that there is room for the fiscal to accommodate a one-off policy package for the property sector. And also, we think there's room to reorient spending towards household to allow for higher social spending and cut investment, which at this point has hit the point of diminishing returns. On monetary policy, we think they should continue to ease, but rely more on interest rate policy rather than credit-based interventions. Turning next to our recommendations on upgrading China's policy frameworks. Given the vulnerabilities that have been built up in China over many decades of debt and investment fuel growth in sort of property as well as infrastructure investment, we think the time is now to upgrade policy frameworks in China to safely transition to a more sustainable growth model. Over the last 2 decades, local governments and local government financing vehicles have borrowed significantly to meet very high growth targets by building infrastructure. And this was accompanied by the property boom in the 2010s. Both of these engines of growth will be slowing down, and essentially you're left with a very high level of debt. So if you look at the left-hand side chart, it shows that provinces at all income levels in China are now above the authorities' own thresholds for monitoring risky debt, which is 60% of GDP. All of them are above it. And the shaded gray bars are the debt of the local government financing vehicles. This is an estimate of the fund. We incorporate this debt as government, we include it into our perimeter of general government because they undertake activities that a government should and do. And so these LGFEs, the local government financing vehicles, that they're off budget, they are, however, very significant in terms of size, as you can see from the left-hand side chart. The right-hand side chart shows that they're actually very interconnected. So these LGFEs are interconnected with the local financial sector, with the real economy, with corporates. They're also connected to households because households own asset management products via the financial system. So there's a higher level of interconnectedness, which means that restructuring this debt will need to be done very carefully and will have spillovers. On the fiscal policy framework in China, we also think that reforms are needed both on the expenditure as well as the revenue side to ensure debt sustainability over the longer term. You can see from the left-hand side chart that we project China's debt to continue rising over the medium term in our baseline. Our baseline is the line that's going up. It's, I think, the blue line that's going up on the left-hand side chart. So absent reforms, China's debt load is going to continue to go up in large part because of a rapidly aging society. And we think that the time is now to, once you use some of the fiscal space in the next 2 years to clean up the property sector. After that, China should embark on a significant consolidation over the medium term, which should entail a cut to off-budget investment. It should entail tax reforms, increasing the retirement age. This is already, I think the authorities are working on it, and this is partially done recently. Combining this with an expansion of the social security, both adequacy as well as coverage to facilitate rebalancing. This package of fiscal reforms we think will be needed. And so the slide also mentions towards the end the sort of fiscal reforms we recommend, which is restructuring the unsustainable LGFE debt and tax reforms, etc. So let's move on. On monetary policy, we think that the framework needs to be upgraded to improve policy transmission as well as more effectively support domestic demand. China's monetary policy has been disproportionately less reliant on interest rate cuts than other countries. If you look at the left-hand side chart, the red line is China. This is the cumulative changes in the policy rate. And you can see that they don't move the policy rate very much. They rely more on structured credit policies, where the PBC provides credit to certain preferred sectors, etc. Compared to other EMs. The EM median is the blue solid line. So it's less reliant on interest rates, but our analytical work actually using firm level data shows that if you look at small credit constraints firms, this is the chart in the middle, this is drawn from a paper that we had done, they are more responsive to interest rate shocks than credit shocks. So if you're trying to target the liquidity constrained firms, you're more likely to do so using interest rates. And so our recommendations that follow from this is that they should prioritize interest rate-based monetary policy, and we have a slew of more detailed recommendations in improving the monetary policy transmission. Turning next to the financial sector, finally, upgrades are needed to the financial policy framework to deal with the potential spillovers from the local government as well as the property sector debt overhang. We see growing asset quality risks in financial institutions from exposure to the property sector as well as local government financing vehicles, as you can see on the left-hand side chart, which basically shows exposure to developers as well as local government financing vehicles as a share of total financial sector assets. We also note that small and medium-sized banks are particularly vulnerable, given that they tend to have lower capital buffers. They also have weaker asset quality as well as profitability. This is illustrated in the middle chart, and we have a series of recommendations around strengthening the financial policy framework. I think in the interest of time, I won't go into all of them. I think we're almost out of time, right? Janak, if I could
continue for some more time, no problem.
I can continue for another.
You have another 10 minutes, no problem.
Another 10 minutes. Okay, so let me spend 5 minutes on each of the remaining topics. So in terms of our recommendations to support sustainable growth in China, I have already mentioned this, so I won't belabor it too much, but essentially the investment-led growth model in China is facing challenges. You can see from the left-hand side chart that China had, these are residuals from an unconditional convergence regression. This is the extent to which China overperformed in terms of economic growth relative to its per capita incomes. The history is the blue bars. On average, China's growth was 5.5% more than you would expect at its per capita income levels. Going forward, we plug in our projections and we see what that does. Essentially, if our projections of below 3.5% growth over the medium term hold, the many decades of overperformance in China will soon come to an end. I've already mentioned a lot of this was due to excessive investment, etc. Another point to make is that as a result of overinvestment, you see the marginal product of capital has been declining quite significantly. Other headwinds to China's medium-term growth is subdued productivity as well as aging. The left-hand side chart shows that essentially SOEs, which are a larger share of the economy, a growing share of the economy, are significantly less productive than the private sector. This is based on firm-level analysis that we did a few years ago. And so this affects overall economy-wide TFP. And also demographics will play a significant role in China in terms of affecting its medium-term outlook, because the working age population in China has already started declining. And as I'd mentioned earlier, putting all of these factors together, we project China's medium-term growth to slow down quite significantly. In 2029, it's around 3.3% or so. I would note that there are downside risks to even this quite sober assessment, because if there's a ramp up in fragmentation, that will affect productivity and further drag this down. Just a few words on our main recommendations for a new growth model for China. For years, we've been calling for a rebalancing towards consumption, greater reliance on the service sector, implementing SOE reforms to close this gap with private firms, scaling back distortive industrial policies to reduce resource misallocation, reducing barriers to interprovincial trade, and also pension reforms to mitigate the impact of a declining labor force. Some of this is already happening. I would say there's progress on the last one. Putting all of this together, we put these reforms into a general equilibrium model, and what we find is that the payoff will be very significant. China's GDP levels can be lifted by 2.5% relative to baseline over the next 5 years, and close to 20% in the next 15 years. So we have, in our last two Article 4s, encouraged the authorities to undertake reforms in these directions. So I'm going to, I think, in the interest of time, what I will do is skip over some of these slides and get to, there's more detail on service sector, etc. Maybe speak about this one because there's a lot of interest in this issue of sort of the new engines of growth in China. So as I had mentioned, growth is projected to slow over the medium term. The authorities' own medium-term plan is to rely more on the new strategic sectors, such as high-tech manufacturing, which is intended to raise economy-wide productivity and support growth. Now, our analysis shows that that's all very good, but these new strategic sectors are unlikely to fully replace the property sector as a driver of growth. So if you look at the left-hand side, we take the strategic sectors such as the new energy sectors, automobiles. We use fairly optimistic assumptions on their growth going forward, and we try to see whether they can offset the projected drag in the property sector. So the negative bars are the projected drag from the property sector, the positive are the impact of the new sectors. And what we find is that these sectors are not going to compensate for the drag from the property sector. Moreover, the strategic sectors, if there's excessive investment in these and a buildup of industrial capacity, that could, unless there is enough domestic demand to absorb this production, it would lead to falling prices and falling export prices and declining capacity utilization in the future. And this can heighten trade tensions, which can further then feed back and hurt the Chinese economy. Turning to the final section on spillovers and trade fragmentation. China's economy, as I had shown earlier, has grown quite rapidly in the past. And you see in the left-hand side chart that this remarkable pace since the mid-1990s has rendered China the second largest economy based on market exchange rates, and the largest on a PPP basis. So of course, it's not surprising that anything that happens in China will have spillovers to the rest of the world. I would also note that Asia in particular has benefited because China has become so deeply integrated into global value chains. So the middle chart shows the increase in trade with China as a percentage. So this is exports plus imports as a share of GDP. And you can see that ASEAN and Korea are in particular much more integrated with China and would stand to face spillovers in the case China's growth slows down. I want to draw your attention to the last chart on the slide, which is a result of, again, it's a multi-country, multi-sector DSG model because there's going to be second round effects, etc. So we wanted to assess the long-term spillovers from China on other economies. And so what we find here is that, again, ASEAN countries and Korea in particular would see their growth affected by, I think, the 0.15 to 0.2%, 0.2 percentage points for 1% decline in China's growth. So this is quite significant. Another aspect of spillovers that I want to touch upon briefly is potential spillovers from Chinese industrial policies. Since 2019, you see a sharp increase in domestic subsidies for industrial policies in G20 advanced economies. This is the left-hand side chart, but you can also see that China has used industrial policies for many years. And the Chinese industrial policies in terms of subsidies equal all of the combined G20 emerging markets and advanced economies. These have typically been focused on upstream sectors. That's illustrated in the middle chart. And this is basically what this has done is to keep industrial production quite stable. You can see this in the extreme right-hand side chart, while domestic demand has been weak. So demand hasn't been able to keep up with industrial production. And our analytical work for the last Article 4 shows that Chinese subsidies tend to increase exports and depress imports in the targeted sectors. So this is the left-hand side chart is direct impact of subsidies on that particular sector, on the targeted sectors. And the middle chart is the impact on upstream sectors. Think steel subsidies rendering automobile production more competitive. And our analytical work also shows that, if there's a great probability of retaliation to industrial policies, which raises the overall cost. Okay, two slides and 2 quick points. First, we are actually seeing fragmentation in the data. We are seeing it in terms of a shift in export shares, left-hand side chart. We're also seeing shifts in outward FDI in China, where it's destined towards politically more connected or countries. We have different ways to measure this. You're seeing it in the data. This was considered a risk a few years ago. Now it's clear in the data. Final slide. We've here estimated the potential costs from de-risking globally. What are going to be the economic costs globally of this scenario? This is based on a DSG model, and we have analysis of friendshoring as well as reshoring. Friendshoring is sourcing imports from your aligned countries, whereas reshoring is bringing production back in advanced economies onshore. And basically what we find is the costs are quite significant. In the friendshoring scenario, globally it's 1.8%. China loses more, it's upwards of 6%. Whereas for reshoring entirely, I think it's 4.5%. I think the interesting point here is that even in the friendshoring scenario, all these bars are negative. What that means is that attempts to gain from trade diversion would be very temporary, because you would, in these kind of scenarios, what we find is that global output is lower. So the effect of trade diversion, so countries who hope to gain from these kind of de-risking scenarios, I would say that we think the effect is going to be very temporary and not long lasting. So I've gone over my allocated time, but I can stop here and